You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Wednesday morning. Today, we are talking about my top 4 Canadian REITs. And before we go into this topic, I just want to I have a few words about REITs. I mean, first, they're not there for growth. And right now, if you look at most of them, and actually the one that I prefer, they all show poor returns. So you get them right now, you invest in those mostly to see them kind of like a deluxe bond. So you will have a decent yield, a decent expectation of dividend increase, so that should increase your yield on cost. So the yield that you're getting like over time, which is better than a bond. But don't expect too much from the REIT price. The unit price should not fluctuate that much. Keep in mind as well that if you hold them into a non-registered account, it could create some funny moment about calculating like the taxes when you sell, because the REITs are not paying dividends, but they rather pay a part of it is like return on capital. So it makes like calculation for taxation a little bit more complicated. So you might want to hold them into kind of like a TFSA or a retirement account, such as a RIF or RSP or whatever. Just want to consider the taxation aspect as well. And you're not going to invest in those for growth. So just to put that into perspective, just be careful with those. And again, not financial advice here, just highlighting some key points about REITs. So let's get started with my favorite one, which one I hold for a while. I've talked about it on the show several times. Granite REITs, GRT.UN.TO. There is a lot of things that I like about it. First, very good yield. Talking about like 5.6. If you're looking for income, this is one that is quite interesting because you're getting almost 6%. But most importantly, the company is able to grow its funds from operation, FFO, and its FFO per share, meaning that they are able to increase their distribution as well. So they show more than a decade of constant dividend increase, along with a healthy payout ratio. So the payout ratio right now is around 70%. Still offering like a roughly like a true 3% distribution increase every single year for more than 10 years now. So this is this is a sign of great stability. The company shows a very high occupancy rate, always well above 90%. And Granite expects also for 2025 that the FFO per unit should grow by 5 to 8%. The adjusted FFO per unit should grow by about 2% at the best case, so 0 to 2% due to higher capital expenditure. But long story short, Granite is in a good position to keep on growing its revenue. They are an industrial REIT property manager, so they focus on mostly a lot of companies that are tied with e-commerce and distribution. And unfortunately, in the part that I dislike about Granite, well, it has a very strong tie to Magna International. For the story, almost about 15 years ago, Magna International spun off all its properties into a REIT, formed Granite. So back then it was like more than 90% of their revenue depended on Magna. Right now we're like at 26-27%, so it's still a big chunk if Magna has to close manufacturing plants that are held and managed by Granite. It's not going to look good, but every year Granite is trying to expand its business outside of the auto part industry. They did a great job, but there's still a lot of work to do. The other thing is, of course, very poor returns over the past 5 years. This is one of the rare holding I have in my portfolio that is negative. But as I said, I don't really look too much about the unit price. What I look about is the distribution and the increase of the distribution every single year. Moving on to Canadian Tire REIT, CT REIT, CRT.UN.TO. Yield of like 6.3% right now. What I like about it, well, super stable, well established in Canada, of course. Growing funds from operation, growing FFO, very low payout ratio as well. That was at 73.6, so 74% for the full year of 2024. So for a REIT that is super stable and able to increase its distribution for more than 10 years also. So similar profile to Granite in that sense. Low payout ratio. This is the type of REIT that I like. I like a REIT that is able to increase its distribution all the time, that has a low payout ratio, so the chances to see the dividend cut are minimal. And on top of that, there is some growth. So this is what I like about Canadian REIT. What I dislike, well, it's almost exclusively just dependent on Canadian Tire. So already Granite was at like 26, 27. For Canadian Tire, I think it's like 97 or something like that. It's just like super high exposure to Canadian Tire. So when you invest in Canadian Tire and CT REIT, you have to track Canadian Tire performance as well. The other thing that I don't really like is the limited growth moving forward. I mean, it's kind of tough for CT REIT to stay with Canadian Tire and hope to grow, because if the retailer is not growing, well, it's going to be very hard just to rely on rent increase to grow the FFO per share. So it will be challenging over time, but again, you're not necessarily buying REITs to grow your portfolio super fast, but it's more in a sense of that you're looking for income and you're looking for safe income. So the best way to find those safe income producers is to find companies that are able to grow a little bit, show a low payout ratio, and able to increase their distribution every single year. If you're looking for companies that actually offer all of this plus some capital appreciation, some growth, I suggest that you download the Moose Market Rockstar list. You can find that at moosemarkets.com/rockstars. The Rockstar list is a combination of Canadian and US stocks that shows constant revenue growth, earnings growth, and of course, dividend growth. So those are the three pillars of the dividend triangle. You can download the list for free, and once you subscribe to my newsletter, you're going to receive the updated list every single month. So at moosemarkets.com/rockstars. All right, moving on. I have like two more to talk about, and time flies. So Canadian Apartment Property REIT, CAR.UN.TO. A little bit lower yield, 3.8, pay monthly. Of course, they're an apartment REIT, like the name says. Very high occupancy rate. We're talking about like something's between 97 and 99% of all properties occupied at all time. And one thing that I really like about Canadian Apartment REIT is their ability to grow through asset recycling. So they are selling like fully valued properties to buy undervalued properties, worked on them, make them better, increase the rent, and then selling them again. They did that for almost $1 billion worth of properties in 2024. So the business doing really great. They are also expanding into Europe. That will be an interesting new development for them. And what I dislike, well, slow growth. Of course, it's not. The key part with apartment buildings is you don't want to go into oversupply, right? So you don't want to run empty properties. So you want to make sure that you have enough people coming in and that you maintain a very high occupancy rate. This is when your properties are profitable. With a change in immigration in Canada, that could hurt a little bit for the growth. And also the expansion to Europe, I see that as a double-edged sword. So on the one side, it could be quite exciting, quite like profitable. On the other, you expose yourself to another economy, to currency fluctuation risk. It's another market, so the dynamics may be different. So all of this could count into the risk factors. The last, but certainly not the least, InterRent, IIP.UN.TO. Apartment REITs, mostly based in Ontario and in Quebec, some in British Columbia as well, offers a yield of 3.75. And their playbook is all about buying undermanaged assets, upgrade them, increase their rental income, and this is how they find most of their growth. So it's not exactly like capital recycling. Their goal is not necessarily to flip those properties down the road, but it's really to make good purchases, work on them, renovate the apartments, and then increase the rental income. Again, super high occupancy rate at 97%, increase the leases, which means that we'll increase the FFO. The payout ratio is around 70%. Another one that has showed more than a decade of distribution increase. So as you can see, there are like recurring themes of like which kind of REITs I'm looking at. I'm looking at those stats: higher occupancy rate, the ability to increase FFO per share, dividend increase, payout ratio in the 70s to ensure that we will not suffer a dividend cut. Speaking of dividend cut, unfortunately, Interrent did cut their dividend back in the financial crisis of 2008. So it happened in 2010. So just keep that in mind. If things go sour, yes, REITs can cut their dividend while their distribution. So you just have to be very careful with that. Again, similar to Canadian Apartment REIT, they are also subject to the immigration policy shift that will also affect their business. So overall, a lot of like better yield than what most of the market can offer, but not so much growth. A lot of work concerns these days, and this is why those REITs are not performing that well in a world that is driven by technology, AI, excitement. We're talking about like very boring stocks here, of course, very boring businesses, but sometimes having some boring stocks in your portfolio will make you happy, because while the stock price performance is not that great, the dividend is there. It is filled with stability. So this is something that you may want to look into. All right, Moose, that's enough for today. Enjoy your day. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.